Welcome back to the Money Under the Mattress podcast. My name is Mitch and my co-host is Jake, and today we are joined by Edwin Dorsey. Edwin is the author of the BRK.B newsletter, which has over 17,000 free subscribers and over 750 paid subscribers. He has been featured on CNBC, the Pomp podcast, as well as much more. We're excited to talk to him today and talk to him about his Substack, Twitter monetization features, as well as how to grow in the investing community. So thank you for joining us today, Edwin.
Mitch, Jake, thanks so much for having me on the Money Under the Mattress podcast. I'm really excited to be here.
We're excited to have you on. As we said before, we were watching some of your latest interviews that you've had, and you're an interesting guy. I've realized it's just more than just on Twitter and through the Bear Cave. So we're excited for this one today. The first question we always ask our guests is how they started in their investing journey. So do you want to talk to us about that?
Absolutely, Mitch. So I've been passionate about stocks from a really young age. Like in second grade, I was all about the stock market. And my grandmother was really nice. She put a little bit of her own money into an E-Trade account and gave me the username and password so I could invest her money. And as like a second grader, getting to play with real money is pretty crazy. And of course, I had no idea what I was doing. But that was a lot of fun, and that got me hooked. Freshman year of college, another big transition happened for me. By coincidence, I met two of the best short sellers around, Mark Cahotas and Jim Carruthers, beginning of freshman year. And they basically became my mentor throughout college. And because of that, I got drawn to the short side and active short community and started becoming more skeptical of a lot of these companies. And then finally, when I graduated, I talked to a lot of hedge funds in New York, but I couldn't find the perfect job I wanted. So I decided to start it out on my own with this newsletter focused on exposing corporate misconduct called the Bear Cave. And that's what I'm doing now. But I've always been passionate about stocks for a long time, as long as I can remember.
So you said that you got in touch with some of the biggest short sellers around. How were you able to get in contact with those guys at such a young age?
So when I was really young, like the two things I found are one, you just have to be proactive. So the principal of my high school introduced me to a hedge fund manager. Then that hedge fund manager introduced me to his son's roommate, who was a big short guy. And that person, Chris Gross, ended up introducing me to Mark Cahotas. So that's how I met Mark, through a lucky set of introductions there. And then Jim Carruthers I was blogging a little on the time on a website called Seeking Alpha. And I think Jim read one of my posts and just DM'd me. And at the time on my Seeking Alpha page, I didn't mention how old I was. It just said I was an anonymous person in Stanford, California. So he met with me not knowing how young I'd be. And then when we got lunch, I guess he was surprised how young I was, and he offered me an internship. So that's how I got started there. But the key I found is when you write stuff online, that's a great networking tool, because people are usually skeptical of young people. They're going to waste my time. How much do they know? But when you write online, you're showing, you're not telling. So that's a great networking tool. To meet people now, I cold email a lot. I think that's really important. And I think Twitter, once you get established in a following, Twitter is a perfect way of networking, because people, again, can see your ideas and see if they gel well with you. And the final great way to network is by starting a podcast, which is what you're doing, because you get a lot of good guests on, and you get to meet a lot of people that way. So I think what you guys are doing is the perfect way of networking as well.
Yeah, I found, so I'm 20 and Jake's 21, so we're fairly young on the FinTwit community, I would say. And yeah, we've heard that. I think a lot of people are just interested in talking or trying to help us out in any which way possible, just based on the fact that we're starting fairly young in our careers. We have something to offer for them, that they want to come on a podcast, discuss their opinions and ideas. And then, yeah, I just started my Substack, and Jake's starting his very soon. And so I've had a lot of people reach out to me and then just try to help me through the process of publishing my ideas. It's one of those things that you don't realize how difficult it is until you try it.
Yeah.
And then you could get backlash, or then you have to explain your ideas that you wrote down. Plus you have to go in detail when people have a question based around those. Yeah, so we've had a lot of people that have reached out and helped us out with that. So
That's good. And one thing I'd add, Mitch, is I'm 23. I'm 1 year out of college. A lot of that goes away once you graduate college. So like the time to reach out and cold email and try to introduce yourself is while you're in college. For whatever reason, like, people don't suddenly mature when they graduate college, but the sympathy goes away as soon as you're no longer a student. You're just a person in the real world, off to fight on your own.
Interesting.
So you mentioned that you kind of take like the bear side of things on your positions. Are you actually shorting, or are you using puts when you're making those positions?
So Jake, it's funny. Everybody always asks me, like, how do you position your trades? I actually don't bet against any of the companies I write about. So in very rare cases, like I've bought puts personally on some stocks. I've never shorted a stock. And I don't bet against the companies I write about. My reason for doing that is just to say I'm independent. You're paying for my analysis on these companies, and if I was shorting them, I might be biased to exaggerate or that sort of thing. Generally for small individual investors, puts would be better because your downside is capped. But buying puts and shorting is definitely not a thing I'd recommend for most individuals. It's the type of thing that works well with hedge funds, but not so much, young people.
Interesting, because me and Jake, we've never shorted. We bought puts once just to kind of test them out, because we've had a couple of friends say, like, try using options. And I felt like if I put maybe $100 into a contract, it would help me understand it a little more. But yeah, we never really understood the purpose of shorting. I mean, we understand the purpose of shorting, but for an individual investor like ourselves, just the risk to reward ratio is just not extremely there. But for a hedge fund, like you were saying, it does make sense.
Yeah, and if you look at like the best short sellers, Jim Chanos, I think if you look at his only book, he's broken even over 40 years, or maybe annualized 1% positive. The beauty of which shows how difficult it is to earn money being a short seller. The only real benefit is if you go short, you can go more long and make an extra 10 or 20% on that side. So instead of owning $100 of stocks, you can own $150 long, hedge $50 short, and hopefully make more money that way. So it's very, very tough to make money if you're just shorting.
If you want to talk about the latest news update with frauds, we could probably talk about the Nicola he was the founder and ex-CEO. Do you have much opinions on him?
So I'm not super familiar with it, Mitch. Now, this might be a controversial take, but sometimes I think the media doesn't do a great job differentiating between like levels of misconduct. Now, Trevor Milton surely did a lot of bad things and definitely was exaggerating. But the one example that gets so much attention in the media is, the truck was rolling down the hill and they pretended it was in motion and like driving when they were just rolling it down the hill. But what people aren't paying attention to is they did that as like a private company 4 years pre-IPO. And yeah, you might have been misleading some VC investors, but to me, that was more just like to build online hype and not so much to deceive investors, because again, they were a private company and this was 4 years pre-IPO, but the media pounces on that and it's like, they're misleading investors with this, when that's not like the true reality. And then really bad stuff like Parker Petit, who was the CEO of MiMedx, and they were just lying about revenue and profits and retaliating against employees and setting up like fake whistleblower lines, like really, really, really bad stuff. And that gets like no attention from the media. So yeah, I think what Nicholas did is bad. My guess is Trevor Milton's going to be found guilty, but I do think there's a chance for a not guilty verdict. But generally, like if I were to say what's the most egregious example of misconduct in the last year or two in markets, I probably wouldn't have Nicola at the top of the list, even though what they did is bad. So that's kind of where I stand. And that's definitely one of my frustrations is the media, and there's a lot of groupthink and everybody pounces on the same things. And sometimes it doesn't make a lot of sense. Like 99% of the people who talk about the truck rolling down the hill don't know it happened as a private company years before the IPO, which is, a very relevant thing. So that's kind of where I stand on that. But I would say we are in a new era of SEC enforcement where the SEC is going to really start going after people in a way it didn't under the Trump administration. So we're probably going to see more people go to jail and more people suddenly resign and more executives stop using Twitter to be promotional, which will be a good thing.
That was actually one thing I did not realize. I thought that when they did the actual kind of promotional video for the rolling down truck, it was within that month that they kind of released, or I guess it went almost viral around Twitter. That was around the same time that Trevor Melton did leave Nikola. I'm not 100% sure. That's the first time that I saw it personally, but no, that's definitely interesting. What would you say the biggest fraud that you've seen, or the easiest short that you've seen so far?
I like that. Fraud is an aggressive word, but the most questionable company I've seen is Ag Eagle Aerial Technologies. The ticker is UAVS. At one point, they were $1 billion company, and what they claim to be is they claim to be a next generation drone company that, like, you know, you fly these drones and they could map out a farmer's field, so you could use them if you were growing marijuana in fields, and like Amazon would use them to scout locations and deliver packages. And you know, these guys had the best delivery drones and scouting drones. In reality, it's like a 6-person company, and all they had was like a remote controlled airplane hooked up to a GoPro, and like that was their drone. And they'd like done $40,000 of R&D in a year. And you know, if you want to know why the stock was going up, these promoters who've been involved in like dozens of pump and jumps took a big stake in this like Liechtenstein-based hedge fund that's super suspicious, took a big stake and installed shoddy management. And they got the stock from 1 to 15. And of course, it was like none of it was real. They'd always pretend like they had a partnership with Amazon or a big e-commerce company. Amazon even explicitly denied having a partnership with these guys. And they still continued to pretend there was an Amazon partnership and retail was buying it up. And since I wrote about it, it's gone from like 15 to 3. But that's just an example where like retail investors can really get their like heads spun. I think my favorite little anecdote from it was the chairman's daughter created like a YouTube channel that would like just, they can't explicitly say they have a partnership with Amazon, but she'd like put up a YouTube video with the Amazon logo and the Ag Eagle Aerial Technologies logo to imply like something was coming. That one was mind-boggling to me. So UAVS, Ag Eagle Aerial Technologies, is one that sits at the top.
And is that something that you wrote about in your bear cave?
Yeah, I wrote about it. I forget exactly when I wrote about it, but I wrote about it 4 or 5 months ago, and since then it's gone from like $14 to $3, and I think it's probably going to end up at 1 or 0.
So when you're writing those bear write-ups, how do you think that's helped you with your long investing? So going long, like the way your mind kind of wraps around when you're writing up a bear write-up, how that helps you for going long, I guess. I mean.
So Jake, I'm not sure if there's a ton of overlap between, you know, doing great critical research and doing great long biased research. It definitely helps me avoid like sketchy situations, because now I can right away go into an executive and see their corporate history. It's taught me not to give companies the benefit of the doubt, and definitely don't always trust management, especially of these smaller companies. Too often you'll see numbers or hear management make a statement, and especially newer retail investors will just believe it, and they'll say, oh, well, if this company is going to do $2 billion of revenue next year, well, then of course they're worth more than $500 million. They should trade it more. But you don't, like, you're just not used to people outright lying or being misleading. So it's definitely taught me to be more skeptical and focus on people who execute. Another thing I get from writing the reports is I think Wall Street is always just too focused on the numbers and the nitty gritty of the financial statements. And, oh, what did EBITDA margins do? Are they up 1%? Are they down 1%? I've learned to really focus on the customer experience, because in the long run, that's what drives value for a company. Does this company have happy customers? Is the product really cool, or is it just okay until a competitor comes in? So focusing on the product and customer experience over, let's say, the financial metrics is another thing I've really gained. And that's something I think, well, not just individual investors, hedge funds do the same thing, where they're just laser focused on numbers and models, but not focused on like how happy the customers are and how great the product is.
So when I watched the Pomp's podcast, Pomp noticed that you were quite a networker, in a sense. And you brought up the fact that you were able to get a meeting with Bill Ackman, who I think mostly one of the most popular people in the investing community, I would say. Do you want to talk to us about that?
Yeah, absolutely. So this was my junior year in college. Stanford had a program, Stanford in New York, which is like study abroad, but study in New York City. And I was there for 3 months. And I said, I'm going to cold email a person every day. So first I go to our Stanford database of alum, and I get a lot of the alums in New York City who are in finance. I get their emails and I just start cold emailing one a day. And then and most of the time they don't respond or they might decline, but a lot of times they do accept and will meet with you. And then Bill Ackman, I started emailing bigger hedge fund managers, and I cold emailed him, and it was crazy. Within like 10 minutes, he responded. And I made sure I made the subject line fan mail, because everyone will read an email that says fan mail. You might not read it if it has a boring subject line. So he clicks on my email labeled fan mail, replies within 10 minutes being like, oh, my secretary will set something up. And we had an awesome meeting. He met with me for 45 minutes to an hour. And then afterwards, I got to meet with one of his analysts. I pitched him 2 potential short ideas, even though he wasn't into shorting anymore. And I thought he was a fantastic, very nice, wicked smart guy. Usually I'd be used to explaining concepts for a long time, but he always is like, I get it, let's move on to the next thing. So he got things really quickly and was really sharp. And I thought he was pretty nice and down to earth. And I think it goes to show the power of cold emailing, because I definitely thought when I sent that email, less than a 1% chance he'll respond, but he responded right away. I also think sometimes it's the luck of the draw. If people are in a bad mood, they just delete that stuff. But if they're in a good mood for whatever reason, they'll reply. So that was one. I'm trying to think if there is that's definitely the one that stands out of the great meetings.
Yeah, that would have been a great experience to sit down with somebody likes of Bill Ackman. Especially the fact that he's had some successful shorts and then some unsuccessful shorts. His successful short was MBIA, is that correct? That was his fairly successful one. And then everybody knows the Herbalife transaction. So was that around the same time that you were talking to him?
No, Herbalife, when I was talking to him, I think Herbalife was said and done, or maybe they had like a put option position. I didn't really ask him about it because I didn't want to bring up the bad memories.
The bad memories. Yeah.
I don't know if I would have said MBIA was a great short. It did work out in the end, but if something takes 7 years to work out, even if you make money on it, it's still just been such a distraction and taken so much time. I don't know if I would consider that to be a real success, because your time probably would have been spent elsewhere. Another thing I would say is there's some hedge fund managers who have a lot of media attention on them. Bill Ackman, David Einhorn, Dan Loeb. There's equally smart people who just avoid the media at all costs. But those people would be just as willing to meet with a young person. And in fact, people would have a better chance at meeting them if they cold emailed, because no one's emailing an obscure hedge fund manager who's like very private. So if a young person's listening to this and how can I meet with a great person, find like the best performing hedge fund managers that attract no publicity and cold email them, and you might get somewhere.
On the topic of Bill Ackman, would you like to discuss what activist shorting is?
Absolutely. So there's 2 approaches to short selling. You can short a stock, which is expressing a bet that the stock will go down, and hope your research proves right, and over the next year or quarter or decade, the company underperforms and goes down. An activist short seller is going to say, hey, I'm going to bet against a company. I'm going to do a ton of work on a company, usually a company that has a serious issue beyond being just overvalued. And then I'll put out a report, I'll make a video, I'll do something so the market will notice and see the way I see. And maybe the stock will fall. So a lot of these activist short sellers will have big Twitter followings and an email list. And once every few months, they'll put out an idea and say, hey, I'm short Herbalife, I'm short Netgear, I'm short whatever, and here's a 20-page report why. Generally, it's really good because if there's a problem in the market, if there's a fraud in the market, you want it discovered as soon as possible. Even if a stock falls 50 or 90% post-activist short report, letting it develop and grow into something worse where it would later collapse, that's really bad for the market. Now, the one thing activist shorts sometimes get criticized for is if you're betting against the stock yourself, and if you're covering, taking off your bet a day after you put out the report, you might be incentivized to exaggerate the allegations, say the company's going bankrupt, use big, bold, red letters with a lot of exclamation points. So you see that sometimes in the activist short world. But activist short selling is just betting against a company and then publicly sharing why and trying to convince people your view is right and sometimes move the stock down.
Interesting. Because I guess there's a lot of people that short, but then they don't want to talk about it. And there's a lot of people that do short and love talking about it because it should hopefully, I mean, if you have a big enough following, then it should gain some type of traction for more like-minded individuals to then say, you know what, let me look into this. So that's similar to what the Bear Cave is about is, you know, you're trying to not bring down the company, but you're trying to say, hey, this is the information that's out there. And then you send it off to people that are following you and then they're going to do their own due diligence, obviously, on it.
Or if it flips on you, right? Like if it flips on you, ends up being the next GameStop, that can be kind of scary too, right?
You know, there's no limit to how high a stock could go. The one thing I would say with the Bear Cave newsletter, you know, my write-ups are usually around 1,000 words. I'm not explicitly recommending you short a stock. I never provide a price target. I more view the newsletter as a way for a hedge fund analyst to read it, see something interesting, and now, hey, they have like the first 3 or 4 innings of research done, and they can hit the ground running if they choose to research it themselves. I'm more like highlighting a bunch of red flags or a pattern of potential misconduct at a company. It's similar to an activist short report, but I don't think I go as far. And that's how I'm able to put out a report every 2 weeks or so.
How are you able to generate so many ideas for shorts? Like where are you getting these ideas from?
So first, I wouldn't say explicitly it's all of them are shorts. It's just sometimes a company that is either misleading investors or hurting consumers. That's what I focus on. Oftentimes, these companies will be good shorts. You know, this is my only job, so I can spend 20, 30 hours a day, 20, 30 hours a week just looking through Twitter, seeing if people tweet something interesting. I read a lot of SEC comment letters, which is informal correspondence between the SEC and a public company. Sometimes there's like glaring red flags in there. I do talk to other people in hedge funds. Sometimes someone will say, hey, you should look into this company. They're doing something weird. In real life, whenever I meet someone, I always ask them, hey, do you know of any companies that are scammy or frauds or that I should look into? That's fun if you get a tip that way. I file tons of FOIA requests on companies to get consumer complaints. And sometimes I'll have a mild interest in a company, but then I'll get emailed back to me like 50 pages of consumer complaints with every consumer being like, this company is scamming me. They keep charging my credit card and I can't get them to stop. They keep raising prices and making it impossible to cancel. That'll attract my attention. The biggest way, the easiest way for an individual is just Twitter. There's so many great people sharing great ideas on there. And oftentimes people will like share a sliver of something that's interesting, but not fully baked. And then I can go and run with that and see if it leads somewhere.
Talking about, I guess, fraudulent or possibly some businesses that are up in air, Do you have much of an opinion on VIEs, moreover like Tencent and Alibaba?
So variable interest entities, these like Chinese companies that list in the US through this weird structure, I don't have a strong opinion. My weak opinion is it's actually not that much of a big deal, the variable interest entity and like the way US people kind of through a proxy own a stake in a Chinese company. I think the bigger thing with investing in Chinese stock is if you're an individual US investor, you are literally the least informed person at the table. The thing that's going to drive Chinese stocks in the long run is going to be regulation coming from the Chinese government. As an individual, you're going to go none of it. Even as a US-based hedge fund, you're not going to own a ton. It's like not a coincidence that the best performing hedge funds that trade Chinese stocks are based in Asia or hire a lot from Asia, and they can understand the culture and the regulations and the way the government's going to act. So I find it very odd if anybody, even if it's like an Alibaba or Tencent, is trying to like view these like just fish in better ponds, play in better markets where you can rely on the numbers more easily and you're not at the whim of a government. You're just not going to win in the long run. And even if you do, it's probably not going to be a home run. Versus in the US, you can totally find a company with cool products and something interesting that Wall Street's missing, invest a bunch in it. And everybody has their own expertise in some areas. Even if someone's not smart, they're going to know something about something. Like if you saw Crocs was getting popular, you could have made 20 times your money in Crocs stock. So playing with variable interest entities and buying Chinese stocks, I would advise someone against it.
Interesting. I will admit, me and Jake both are in Alibaba, so it's always good. We're always interested to hear like both sides of the story. So that's why we asked beforehand of saying like, hey, we own a little bit of it.
Yeah.
But yeah, there's a lot of things with VIEs. Some people think that Alibaba's numbers, moreover, could be fraudulent. They could be misleading. And then others are like, no, this thing is the next Google. It's going to go to 5 trillion market cap in the next 10 years. So it'll be an interesting thing. But yeah, I am with you on that one. Is the VIE structure is not the first place I'm going to go fishing, especially for good businesses. It's not the first place, but it's not the last place, I think. Is there any other countries that you ever look into when investing, or is it strictly just US?
We're going to take a quick minute to talk about Quartr. Quartr is a new way of doing company research. Their first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. Their second mission is to create a completely new way for companies to reach their investors and vice versa, to change the way people look at investor relations. Their initial core product is now available for both iOS and Android, but stay tuned for additional features during the coming year. Now I'm going to turn it over to Mitch to say what he's been listening to on Quartr lately.
Yeah, through this past week, there's been a lot of earnings coming out. I've listened to Facebook's earnings as well as Equitable Group's holdings, Equitable Group earnings, which we're an owner of. And so both earnings, I mean, Facebook wasn't the greatest that came out, but the conference calls were great, easily able to get into them. I had a notification for the fact that I am a holder both in Facebook as well as EQB.TO on my watch list tab. So it's just it was great to have Quartr.
Quartr is 100% free. They include companies from 15 markets today and plan to add more during the coming year. They prioritize requested companies, which you can easily do in the app. They have a lot more in store for the back half of the year. So make sure to follow Quartr on Twitter. And that would be at Quartr_app. And Quartr is spelled Quartr. That's Quartr. Now we'll go back to talking with Edwin.
So it's really US for me, especially because so much of what I do is around the Freedom of Information Act request and sending requests to the government for consumer complaints and other information. I don't think other countries have as robust a system. I don't think you could get them if you weren't a citizen of that country, and I don't know how to navigate that. But if I was an individual investor, I think there's, in some countries, there'd be a lot of room to like invest and make money. Particularly, like if I was looking to invest in other countries, I'd find one with a strong rule of law, because that's key for great long-term returns. And then find somebody writing a newsletter, a smart person writing a newsletter on small cap stocks in that country, and follow them. Like there's one guy, Asia Century Stocks. I think he's like writing about companies in like the Philippines and like Hong Kong and Singapore and stuff like that, and finds these really weird, like, you know, cow companies and like small casinos, and they'll go up 10x, and it's like, this guy's smart. So that has my attention. There was Connor Haley at AltaFox Capital. He published this amazing slide deck, makings of a multi-bagger, where he looked at like the 100 best performing small caps over the last decade. And it turns out tons of them were from outside the US, in particular European countries like France, the Netherlands, Sweden, and Australia had a lot. I can't remember all the countries off the top of my name, but that got me thinking, like, if I was gonna spend a lot of time on the long side, I'd want to like look in some of these countries to find the next multi-baggers.
Do you run a pretty concentrated portfolio yourself? Or?
Jake, I run a very concentrated portfolio. I have 75% of my net worth in Twitter stock right now. So I am heavily in Twitter. I think almost always I'll have like 50% of my net worth in something. So I pound the table hard when I like something. I use a modest amount of leverage usually. But yeah, I am heavily concentrated. Also, sometimes I'll get like so excited, I'll just buy a ton of call options on something, and I'll be up 100% in a month. I'll be down 50% in the month. I don't think anyone has a more volatile portfolio than I do. So it scares people, but.
That's awesome. That is awesome.
So when you went on your interview for CNBC, you actually discussed Twitter and their new ventures into monetization.
Mm-hmm.
I guess that kind of brings the idea of, I'm not sure if you have an idea or not, or an opinion, but the fact that Twitter could have its own influencers, similar to like Instagram, YouTubers and TikTokers are solely pretty well based. A lot of their following on their own social media accounts for each social media brand, such as TikTok, Instagram, YouTube. Do you think that Twitter will have Twitter influencers at one point?
Yeah, I would say that even exists right now. Like you could say I'm a Twitter influencer, albeit a smaller one than most. The thing is, Instagram and Snapchat and like Facebook, so many of the influencers are like, look how good I look, or look at this like niche hobby. Twitter is a lot more about ideas and intellectual conversation. So that does a lot better with newsletters and podcasts and that sort of thing. So half the new subscribers for my newsletter come from Twitter, and that's not an anomaly. Almost every email newsletter grows through Twitter, with 50 to 80% of new signups coming from Twitter. Like none grow through Facebook or LinkedIn or Snapchat or anything like that. So yeah, I totally think Twitter is going to have its own set of influencers. The cool thing about Twitter is it really allows people to delve into cool niches. And then with niches, you can monetize that through super follows, Twitter's new product, or paid subscriptions of some sort. While with more general stuff in social media, you monetize it through advertising, which is still fine, but it's not as good as paid subscriptions.
Interesting. Yeah, we find with our podcasts, like we're on YouTube, we're on TikTok, Twitter. What else are we on? Instagram. And by far, Twitter is the best. Obviously, like YouTube does help a lot, quite a bit, but Twitter, we've been able to grow fairly fast within the short period that we have been doing this podcast, and we've gotten a lot of good insights from other individuals, because there's so many smart people on Twitter that can help you out. So I am, even though I'm not in Twitter, I'm a big bull in Twitter for sure. Because when I'm not sure, do you know Guy Spear?
Yeah, I know of him. I've never met him.
Okay. Yeah. So when Guy Spears' portfolio, when he started buying into Twitter, that's when I kind of piqued my interest into it at around $35 a share. And I'm kicking myself now as I didn't realize at the time how good Twitter actually was of an app. But then once I start using it and I can see that their monetization features as well as Twitter Spaces is very well run. Yeah, I'm a big Twitter bull.
I'm a mega Twitter bull. I think there's so much room to run right now. And the craziest thing is like compare Snapchat and Pinterest are like trading at 25 times revenue. Twitter's at like 10x revenue, which is nuts because Twitter has a ton more room for monetization. Twitter like hasn't turned the lever at all. There's right now, for example, there's an account called Moonshine Trades. He's got 30,000 people following him for free on Twitter, and he just tweets trade ideas. Then he has a locked account, and he'll charge people like $60 a month or something like that to follow him on the locked account, and he needs to bill it off platform. And then they get like more up-to-date trades and like even more premium ideas from him. And that's exactly the type of business that I'll be in Twitter's new super follows feature, where directly on the app, on the same profile, you can say super follow me, and for $60 a month, you'll just get the stuff behind the paywall, except it'll be billed through Twitter, and Twitter will take a 20% cut. That's going to be wildly profitable and successful. I think Twitter's going to release that publicly in the next month or two. Then that'll just change the whole story. I think Twitter has a lot of room for e-commerce because Twitter gets tons of data on users, and instead of just seeing an ad that takes you to another site, a company can just advertise a product. And once Twitter has your credit card info for one thing, they can say, buy with one click and we'll ship it to you. And I think that's going to be super successful. I think the Blue subscription is going to be really successful within certain niches. Ticketed Spaces could be good, but super follows is going to be so successful because Twitter right now is the best way for an online creator to stay close with their audience. You can share your ideas. You can do a Twitter Spaces for audio. It's the best way to stay close with your audience. So of course you're going to monetize your audiences through super follows. It's so much better than like a Patreon or something like that. So I am hyper bullish. And it's one of those things where like you ask anyone on Twitter a lot, and they're saying, I'm excited. I like the new things they're rolling out. This makes sense. And you go talk to people on Wall Street and they're like, oh, I don't understand it. Or buy Facebook, it's growing faster. Like all this nonsense. So I think Twitter is going to massively outperform Facebook over the next 5 years. And I think Twitter, if it executes well, has so much room to run.
So you were talking about cold calling or cold emailing earlier. Have you ever tried to cold email or try to get in contact with Jack Dorsey?
No, I've started DMing some Twitter employees. I want to get in contact with Jack Dorsey at some point. Part of it is like, for someone that big, especially at my age, you know, you want to be ready the one time you meet. So maybe in a month would be the better time, because the worst thing would be to like meet now if I'm not super prepared and wouldn't know what I want to talk about. But no, I should email Jack Dorsey at some point. Everyone always asks me, because I'm Edwin Dorsey, if we're related. As far as I can tell, no. Maybe distant relatives. But I'm a huge Jack Dorsey fan. And that's another thing that irritates me about Twitter bears, is they just don't like him for no good, clear reason. My favorite thing is people are going to be like, oh, Jack Dorsey, he has 75% of his net worth in Square. So you shouldn't buy Twitter because he's focused on Square, and Square is more of his net worth. And then he's like, well, Square, which he founded, is up 20x since its IPO in 2015. So it's just so mind-boggling. You're telling me because he ran a company super successfully, that's done super well for shareholders, you shouldn't buy his other company? Are you mad? And then, you know, he's public about his schedule. He goes to Twitter from 9 to 2, which is 5 hours, and works at Square from 2 to 6, which is 4 hours. So he spends more time at Twitter. And then when he donated $1 billion of stock during the pandemic, which was good, he donated only Square stock and no Twitter stock. Another sign he views Square as fully valued potentially, and Twitter as the undervalued one. It's just like mind-numbing when you like don't invest in Twitter because he has more of his net worth than Square, because Square went up 20x. Like, get out of here. So that's where it's so silly, the takes on Twitter I see.
Do you ever see Twitter getting to a level where they have other kind of things with like other features within their actual? So, I mean, obviously they have a feature of Twitter Spaces, which is similar to Clubhouse. But do you ever see Twitter getting somewheres where they have their own type of Substack website?
Oh, absolutely. Mitch, they acquired a newsletter. A few months ago, Twitter was in the news because they tried to acquire Substack and Substack said no. And then Twitter bought a Substack competitor called Review. And right now you can start a newsletter through Twitter Review, and they only take a 5% cut. I think Substack's really good, so Twitter's gonna have a tough time starting this, but they already did that. And I 100% think Twitter's made clear they're gonna now experiment and test with a lot of products and take out ones that go poorly. So yeah, they're already doing a newsletter. You can start a newsletter through Twitter, and an advantage Twitter will have is that people right now, they go to my Twitter and I send them from Twitter to my Substack. If they ever figured out their newsletter company well, you could just say sign up with one click without even leaving Twitter. So you can come to my Twitter profile, see my tweets are smart, and just subscribe to my newsletter in one click somewhere on my home profile. That's hugely valuable, being on the same face, the same like distribution channel, rather than like every small amount of friction in online businesses hurts a ton. Like the toughest thing in any online business is getting people to enter their credit card info, because so many people bounce off that page. But once Twitter gets your credit card info for one thing, they can make it so you just sign up for one click with everything else, which is huge. So right now, Twitter has like 200 million daily active users. 12 months from now, Twitter is going to have the credit card info for tens of millions of users. And those users with one click can super follow accounts they like, pay money to get extra content and extra tweets in a closer relationship to accounts they like. They can pay money for a ticketed spaces to join a live audio event, maybe a Q&A with someone they find interesting. Again, pay with one click. You can make an e-commerce transaction for one click with an ad you see that's cool. And you can sign up for Blue, which is their premium service. It's $3 a month with one click. And the thing is, like, so many people like me, I get so much value out of Twitter. If you told me my Twitter account was like locked and I needed to pay 50 grand to like unlock it, otherwise I couldn't have it, I would do that in a heartbeat. And so many other newsletter authors and creators would, because it's like, it's worth so much more than that. So of course they're gonna figure it out. And the thing is, like, about Twitter is people say, oh, they haven't executed, they didn't do well, it's just never worked. Well, Jack Dorsey became CEO in 2015. And first, he changes the employee base. He gets a new CFO. He gets a new head of product, Kayvon Baker-Poor, who's excellent. Then he changes the culture. He gets the engineers all excited. Then he focuses on the health of the platform, because when he took over, Twitter wasn't growing and there was fewer posts every day. He figures out the health of the platform a little. He cuts political ad spending, stuff like that, that doesn't hurt the financial, that hurts the financials in the short run. And now they have a healthy platform, an excited engineering base, and a good team. Now they can focus on monetization. But everybody else is just like got their wires crossed and is like, oh, it's never worked in the past and it's never going to work in the future, when that's just not true. Oh, and by the way, his other company's up 20x in the last 5 years. So he's not a bad CEO. That's where I stand on Twitter, and that's why I got 75% of my net worth in it.
I can understand that now, why you have 75% for sure. It sounds like you're very passionate and very bullish, obviously, on Twitter itself, based because a lot of your business would come from Twitter. But then for your bear cave, do you find that Substack has helped out a lot for people having the actual Substack website or app? Do you find you get a lot of business through that?
No, so I think I'm a big fan of Substack. They take a 10% cut of all my revenue from subscriptions. I wouldn't say, if you go to Substack, you're on your own. You got to generate traffic. They say they might help you a little by having leaderboards. People go to their leaderboards, they see me, and then sign up for my newsletter. Well, one hidden benefit of Substack is that about 25% of people who sign up for my Substack have already signed up for another Substack and paid. So Substack saves their credit card info so they can sign up for mine as a paying subscriber with one click. That helps reduce friction and will lead to higher paid conversion. But the big thing Substack gives you is they make it super easy to start an email list, and they'll automatically create a nicely formatted website, and they'll make it really easy to convert free to paid and have all the tools for you to do that. So I write a newsletter, like you said, it's 17,000 people on the free list, almost 1,000 people on the paid list. It's, a decent sized business, and I spend like 1% of my time on customer service and complaints and like figuring out like formatting issues and stuff like that. And I get to spend 99% of my time writing. So of course, like I pay 10% of the revenue to get all the headaches out of my life. And, with their sleep technology, it's easier for me to convert free to paid. Hell yeah, I'll do that. I'll do that anytime.
So how long ago did you start your Substack?
I started it like right as the pandemic was starting, I believe in March 2020.
Okay, so
that's when I started the free version. And every Monday, I would like recap new activist short campaigns. And I started it by tweeting it out. And that got me my first 300 people, and it kind of grew from there.
What made you start it?
So a few things. Part of me, I just like writing online. I think it's a great way to network, to learn. Part of me was I was looking for a job. I wanted to be in New York City. And I thought this is a great way to keep my name in there, to stay sharp. People are going to forward it and reach out. My plan initially was grow to a huge email list, people saying, hey, this guy's really smart, announce I'm looking for a job and just get hired somewhere. But then it's really started to grow. And it was during the pandemic, and I was at home, and I was reading about other Substack authors who were making mid six figures. And I was like, well, maybe I should give this a shot. And I didn't love any of the hedge funds I talked with. They were perfectly nice, but it's just like when you're a young person, you don't have a lot of autonomy. You need to do a lot of modeling, which really isn't my thing. You kind of lose your soul a bit. So I decided to start paid subscriptions to the newsletter, and like right away, it just took off. It was so fast growing. Substack CEO reached out to me, just like wondering what you were doing. And I knew right away, like, it would be a success after that. And it just continued to grow and exceeded my wildest expectations. And now I got like, a huge newsletter. I have a ton of fun. I can sleep in as much as I want. I could go on vacation for a few days and no one would know. And it's like a dream job for sure.
Do you have any tips for people beginning their own Substack, or even just on Seeking Alpha, or just writing on their own blogs?
My biggest tip for anybody is, first, you got to like be smart yourself and try to learn as much as you can. And the second is build a Twitter audience. Twitter is the best platform just to grow an audience. And once it's much easier to grow to a Twitter from 0 to 10,000 and then use that to start a Substack. It's basically impossible to start an email list with 10 people and grow it to 10,000 organically. That just doesn't happen. You need to grow your Twitter and use your Twitter to promote your Substack. Grow your Twitter and use your Twitter to promote your podcast. Twitter, it's fairly easy to go from 0 to 1,000 to 10,000 if you like consistently put out good content for a year. So my biggest advice to anyone starting anything online is start a Twitter and grow a Twitter. And the way you grow a Twitter is there's this great video, David Perell and Matthew Kobach. It's like an interview between the two. And Matthew Kobach used to run the Twitter account for the New York Stock Exchange. So he knows all the ins and outs of Twitter. And it's like you build threads and people will follow you. You reply to big accounts quickly and people see your reply. You never use hashtags or hashtags, because if you use too many of them, your account's seen as spammy. Stuff like that. The best performing tweets are usually all text. So you want to have a lot of those. And once you implement the best practices or sharing cool ideas and start tweeting 2 or 3 times a day, it's going to grow. You're going to build an audience and people will like the stuff you do.
Yeah, I actually was just looking through Twitter the other day, and I came across that video that you shared with the New York Stock Exchange writer. Is that what it was? He was the
He was the social media manager for the New York Stock Exchange, and he would like, because there's such big advertisers on the platform, Twitter would reach out to them proactively and be like, here's all our like top tips to maximize your reach. And then he shared those with everybody.
Yeah, there's definitely a lot of information that's in there. So I do highly recommend that to anybody that's starting a Twitter or just trying to grow their Twitter in general. I think it's like an hour and a half long video, give or take.
Yeah, it's really long, but I tell people it's worth it. So.
But it's definitely worth it for sure. Yeah. What would you say your key influences, or who are your key influences that have helped you out throughout your career?
So Mark Cahotas and Jim Carruthers, at least on the short side, freshman year, they started mentoring me a lot. There was a hedge fund manager in Rochester who in high school, Lawrence Creatora at Perspective Capital, he was a big mentor. Some of these other newsletters have given me a lot of great advice. So Petition is one that really helped me out a lot. So that's been a mentor. You know, I think I have a lot of great friends, and you know, having good friends is important. Yeah.
Where do you see the bear cave in the future? Like, how do you want to basically, where do you see it in the future, and how do you think it's going to progress?
So there's 17,000 people on it now, Jay. And right now I really only talk about stocks. I could see it growing into more of a mainstream thing where it's still primarily focused on companies that are hurting shareholders or hurting customers and being misleading in some way. But I could see it also developing into more of a social activism thing. So I could write open letters to the SEC saying, hey, consider changing this rule or changing this policy or going after these bad people. You know, I could focus on individuals rather than just companies. Maybe I'll focus on a private company. There's like one company I'm digging into that like works with a lot of prisons, and they do like phone systems for prisons, and they like overcharge people and just do all these things that hurt like the lowest rungs of society. And I can't stand that. So I could see it becoming even more. Right now, I would say it's similar to journalism. I could see it moving more in the journalism direction, where I do still focus on companies, but they could be private. They could be companies that might be good for shareholders, but are still harming society, and that irritates me. I could see it moving in that direction. You know, I think the pricing now at $44 a month or $440 a year is, you know, decently priced. I don't see that changing. I definitely see it growing. Right now, it's still growing like 20% a month. So that means it's doubling every 4 months. And that means a lot of dollars if it keeps growing. But I just could see it moving more in a social like activism type of way rather than just stocks.
To go back onto the topic of your Twitter and how you grew it, what are some of your key tips that you found helped you grow your Twitter over the year?
The biggest thing is just trying to, you know, get in people's DMs and just like introduce yourself and you reply, just try to start forming relationships with people out of a genuine respect for what they do, not because you want anything. And then if you do that, and then 9 months later, you have something that's relevant to them, you can DM them it and they might retweet it. Trying to meet people in person because that builds goodwill. And like Mark Cahota has gotten me my first 500 Twitter followers just by tweeting to his big audience, hey, everybody follow @StockJabber. That's key. Making lists, I don't know why, but just lists of like 1, 2, 3, 4 really does well. So I made like a list of the 20 best Twitter accounts to follow like a year ago. And I just ranked 20 popular accounts, and every account would be like, oh, thanks for ranking me number 7, really like it. And that drove a ton of traffic to my Twitter account, and a lot of people subscribe. What else to grow at Twitter? The key thing is you can't always be tweeting about photos or links and stuff. Like just text-only tweets do really well. If you look, two great examples of accounts that have just grown with tons of high engagement are at Postmarket and at Real Estate Trent. The Real Estate Trent, it's an anonymous dude. He is only talking about strip malls. So having a focus really helps too. And all he talks is about the strip mall business, and it's always just all text tweets, and they get tons of engagement. So you need to have a focus. That's one thing I didn't mention. Like the saying Warren Buffett says is you can have a ballet you can have a rock concert, but you can't advertise the ballet as a rock concert. And you can't also be doing both at the same time. I make this mistake, but people want to follow you for the reason they followed you. So if they follow me, they don't want to know my takes on football or basketball. They don't want to know about my complaints about New York City apartment prices or my views on the tax code. They want to know about frauds and corporate misconduct. So stay on that focus for 90% of your tweets. Too often, these accounts with huge followings are tweeting at the baseball game or sunny weather. And I get, you can run yours how you want to run yours, but if you're trying to maximize the value for your followers, stay on brand, stay focused.
Well, it's been awesome having you on today, Edwin. It's been a really great time. And where can the listeners find you, and how can they get to your Substack?
Mitch, Jake, thank you so much for having me, guys. I'm on Twitter at StockJabber. If you Google Edwin Dorsey, it'll also come up. And my Substack is called the Bear Cave Newsletter. You can find it on my Twitter, or if you just Google the Bear Cave Newsletter, it'll come up.
Perfect. So we'll put the links to the Bear Cave Newsletter as well as StockJabber down below in the description. And thank you very much for coming on today.
Yeah, thanks so much for having me, guys.
Awesome.
Appreciate it.
Thank you, Edwin.
Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for your entertainment and education purposes only, and we hope that you enjoyed it.